Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management with your weekly market and economic update for the week of July the 25th, 2021. As always, please make sure you read the disclosures that were attached to this video. Or if you're watching on social media, you can simply go to lplresearch.com and read any of the disclosures that you might find therein. So we are into 2021, actually almost through January, and yet I think someone forgot to tell Washington because this seems like deja vu all over again. As I'm recording this video, the U.S. House of Representatives, they're delivering the articles of impeachment to the U.S. Senate for President Trump. And it looks like we're going to have yet another Trump impeachment trial. And while it seems like everybody's really fixated on the political environment and the effect that that could or should be having on the economy and ultimately by extension the stock market, what I thought I would do is just remind all of you that while the political environment is important, it's yet only one of 20 different economic indicators that we look at. For example, we also look at monetary policy, interest rates, U.S. economic outlook, the labor market and unemployment, housing, mortgages, the inflation, the cost of energy. See, these are a lot of things that we're looking at. Out of the 20 most important, political environment is just one. So once again, we want to make sure that this does not become our fixation and that we use that one economic indicator to determine what our own investing style or investing direction is. So in today's commentary, we're going to talk about one of the other economic indicators, and that's corporate earnings. You see, corporate earnings tell us a lot about how we're doing in the whole grand scheme of things. For example, if you owned a company, wouldn't it be important for you to know, are you earning more or less than you did a year ago at this point? Are your earnings growing or your earnings go backwards, right? And as we now are going into the fourth quarter earnings season of 2020, this is going to be equally as important. You see, this week alone, 23% of the companies of the S&P 500 will be reporting their fourth quarter earnings, which is going to shed some light on how long the earnings recession that we feel that we went into in the first quarter of last year, how long that earnings recession may last. You see, the first three earnings seasons of 2020 showed steady decline in profits. And unfortunately, we expect to see this in the fourth quarter numbers as well. However, we do expect this to be the last down quarter for corporate earnings and what we refer to as the earnings recession or a period of consistently decreased corporate earnings. Now, there are four significant reasons that we expect to see a sustainable uptick in corporate profits as we now move into the first quarter of 2021 and beyond. Number one, higher consensus estimates. You see, experts have increased their earnings per share estimates by about 2.3% from the third to the fourth quarter of 2020. This is a sign that companies are strong enough to increase their earnings by the normal amount, at least in the near term. The second reason is guidance. Corporations sometimes provide guidance or some information on how they're doing before earnings numbers are released. And typically we see about 33% of companies of the S&P 500 offer earnings guidance before their earnings. And this time we've had 66% of the companies of the S&P 500 give early guidance, and that early guidance looks good. The third thing, manufacturing boom. The December 2020 ISM, or Institute for Supply Management, hit its second highest level in 15 years. You might be wondering, what's the significance of this? Well, the ISM is typically the best signal of upside earnings surprises. It also parallels corporate profits, and the positivity that it's showing indicates corporate profit growth ahead. And the fourth is economic growth. Despite the fact that the jobs numbers as well as retail sales have certainly not been stellar, the fact is that economic indicators have continued to get better during the Q4. of 2020, especially we compare where they were about a little under a year ago at this time. And as an example, we expect GDP, instead of going backwards, we expect the GDP to actually grow by about 4.2%. So our economy, rather than contracting, is expanding. All very good news for the US economy. Now, earnings seasons answer a lot of questions, and this time will certainly be no different. At Fross and Fross Wealth Management, we're looking for a few specific answers. Number one, what will the impact COVID-19 have on the first quarter of 2021? You see, earnings estimates were higher for the fourth quarter of 2020, but will the new restrictions, as well as the continued uptick in new COVID-19 cases, stunt that growth and keep us in an economic soft patch? We hope not. Number two, can the winners continue to shoulder us? You see, as we look at how companies have performed leading out or really through COVID-19 and then through the summer and now to where we are now, we saw the names, the corporations that really seemed to do the best were the growth style stocks, companies that really profited from social distancing, like technology, like internet names. And we've seen some of the value stock names really lag. So the first question would be, can the growth names continue their earnings growth? And are we going to see a return to higher growth in the value style names? The future will tell us. This week, markets will be listening closely as companies, as their leaders share the details of their fourth quarter with the world. And it's going to be important that the markets hear positivity on these calls. And hopefully they feel secure that sustainable growth continues ahead. One thing's for sure is you can expect your team here at Fross and Fross Wealth Management to be paying close attention to these calls as we look forward to sharing our insights with you, either in person or through future calls and Zoom meetings. Just a reminder, we are fully operational here at the office. About 50–60% of our clients feel comfortable now coming into the office and visiting with us face to face. We still have some that we're visiting only through telephone calls and Zoom meetings. We're here to meet with you in the way that you feel best. Well, once again, in behalf of the entire team here at Fross and Fross Wealth Management, stay healthy, stay safe. We look forward to seeing all of you soon. Have a wonderful day.